Today, my team and I will be presenting on derivatives market and voluntary carbon market. Here's our presenters for today. Derivative markets. Derivatives are financial instruments that derive their value from underlying assets like stocks or interest rates, helping manage market risk and potentially enhance returns. Common types include futures and options. Futures contracts require buying or selling an asset at a predetermined price on the future date, while options give the right but not the obligation to buy or sell an asset at a set price within a time frame. Derivatives serve three main functions, starting from hedging, which is managing risk by offsetting potential losses from adverse price movements, then speculation, which is profiting from anticipated price movements without owning the underlying assets, and arbitrage, which is exploiting price differences between related assets or markets for profit. Futures contracts traded on a regulated exchange provide liquidity and transparency. Overall, derivatives are essential in modern financial markets, offering tools for risk management, investment strategy customization, and contributing to market efficiency and liquidity. VCX. The voluntary carbon market lets individuals and companies voluntarily purchase carbon credits to offset emissions, funding projects like reforestation and renewable energy. Unlike mandatory markets, participation is optional and supports sustainability goals. In Malaysia, BCX oversees these activities, providing a transparent trading platform that encourages sustainable practices and supports the country's climate action efforts. This helps fulfill corporate social responsibility and mitigates climate change impacts.
Firstly, for challenges, we have complexity in the derivative market. Navigating the derivative market can be daunting due to its complexity. It requires specialized knowledge and training, making it tough for many investors to fully understanding these financial instruments and start trading confidently. Second is the distrust in the voluntary carbon market. The voluntary carbon market faces a significant trust issue. Without consistent standards or governance, verifying carbon credits become a challenge. This inconsistency makes it hard for investors to trust the reliability of these credits, affecting their confidence in the market. Secondly, for opportunities, we have growing demand for risk management tools in the derivative market. Market volatility is increasing the need for risk management tools like futures, options, and swaps. These tools are crucial for protecting assets and making informed decisions in today's fast-paced market. Secondly is the technology and innovation in the voluntary carbon market. The voluntary carbon market is innovating with carbon renewal and ecosystem restoration, led by startups like Silvera and Soil Capital. Major investors like BlackRock and Temasek are funding green initiatives, merging e-commerce with sustainable solutions. Lastly, for innovation, we have blockchain technology in derivative market. Blockchain technology offers significant benefits, which enhancing securities, efficiency, and transparency. It enables real-time tracking and confirmation of transactions, eliminating intermediaries and reducing counterparty risk. Blockchain-based smart contracts automate contract execution, lowering operating expenses and mitigate disputes. This innovation empowers market participants to trade derivatives with greater confidence and trust. External factors play a pivotal role in both derivative and voluntary carbon market. First, we have regulatory changes. Regulatory reforms such as the Dodd-Frank Act and AMER have had a profound impact on derivative trading. Designed to enhance risk management and transparency, this regulation enforce strict trading limits, clearing requirements, and transparency measures. Second, we have technological advancement. Technological innovation, notably blockchain technology, have transformed the voluntary carbon market. Blockchain provides secure and transparent transaction records, facilitating the creation and trading of digital carbon credits. This innovation improves the efficiency and trustworthiness of carbon offset initiative, ensuring more reliable environmental impact mitigation. First, we have complexity, and the impact on market participants are the complexity of derivative make it difficult to understand quickly. which limits many potential participants from entering the market, and it also leads to frequent valuation errors. Second, on market stability, valuing and pricing derivatives often involve errors and misjudgment due to their complexity. This inaccuracy can lead to market inefficiency and instability. Lastly, on investor confidence, the confusion caused by the complexity of derivative reduces trading and investor confidence. This hesitation worsens market uncertainties, making it challenging for investors to trade with certainty. Next is distrust, and the impact on market participants are unclear rules and standards regarding carbon credit legitimacy hinder market player trust. This uncertainty reduces engagement and raises costs. Next, on market stability, fluctuating carbon credit prices influenced by verification uncertainties pose investment risk. Companies' reluctance to commit long term, which slows market growth and stability. And lastly, on investor confidence, lack of trust in the voluntary carbon market discourages investor participation, and uncertainty about the risk assessment limits market growth. Moving on to opportunities is growing demand for risk management tools, and the impact on market participants are innovation in risk management tools meet increasing market demand, offering sophisticated solution tailored to diverse segments. Next, on market stability, effective risk management enhances market resilience against adverse changes and systemic risk, ensuring stability during market stress. Lastly, on investor confidence, access to robust risk management tools boosts investors' confidence, increasing participation and market liquidity. Next is technology and innovation. Impact on market participants are venture capital drive innovation in carbon renewal and environmental restoration, creating a dynamic market environment. Next, on market stability, stable venture capital funding supports sustainable projects, ensuring market growth and stability. Lastly, on investor confidence, participation of venture capital firms like BlackRock and Temasek build investor confidence, attracting more investment and fostering market growth and innovation. Lastly is innovative practices and their implication on market development. First is blockchain technology in derivative market. Blockchain enables peer-to-peer trading via smart contracts, ensuring secure transaction, reducing risk and broadening market access. And their implication is blockchain enhances transparency, reduce risk and build trust with tamper-proof records, fostering market integration and participant confidence. Second is nature-based solution in voluntary carbon market. Nature-based solutions like afforestation and sustainable land management reduce carbon dioxide levels, enhance biodiversity and strengthening the community resilience. And their implication is this solution attract sustainability-focused participants, which drive growth and promoting eco-friendly practices.
For analysis of regulatory framework, first we have scope and coverage. For scope and coverage for the derivative market, the derivative market includes future, options, swaps, and complex financial products regulated by framework like the Dodd-Frank Act in the US, EMIR in the EU, and the CMSA in Malaysia. This regulation aims to reduce systematic risk and improve market transparency. For voluntary carbon market, governed by VCS and gold standard, this market includes projects like reforestation and renewable energy. The MGTC oversees this project in Malaysia, aligning with international norms for credibility and effectiveness. Legal basis is the second factor of the analysis of regulatory framework. Derivative market legal framework includes the Dodd-Frank Act in the US, EMIR in the CU, and CMSA in Malaysia, ensuring regulatory oversight and reducing systematic risk. For voluntary carbon market, based on international standards rather than national legislation, Project follow guidelines from organizations like the Gold Standard Foundation and Vera in Malaysia. MGTC promote and verify carbon offset initiative. And for the regulatory bodies is a third fa- third factor of analysis of regulatory framework. For the derivative market, key regulators include the SEC and CFTC in the US, SMA in the EU, and the SC in Malaysia, enforcing compliance and monitoring systematic risk. For voluntary carbon market, standard setting organizations like Vera and Gold Standard provide oversight with MGTC, ensuring Malaysian projects meet international standards. Impact and effectiveness is a Impact and effectiveness is a last factor of analysis or regulatory framework. Derivative market regulation have reduced systematic risk and increased transparency, but also raised operational challenge and compliance costs. In Malaysia, SC monitoring has enhanced market stability. For voluntary carbon market, regulatory system have improved the credibility of carbon credits and stimulated sustainable investment through challenges like scheme uniformity persist. MGTC efforts have bolstered Malaysia carbon credit credibility global.
Okay, for my part, I'm going to present a comparative analysis of derivative. For Malaysia, the regulator for derivative market is Suruhanjaya Security Malaysia. For Singapore, the Monetary Authority of Singapore. For Indonesia, Otoritas Jasa Kewangan. And the last one is European Union. They use the regulator the European Securities and Market Authority. The product that Malaysia derivative market offer are equity derivative, financial derivative, and commodity derivative. For Singapore, is similar equity derivative. That the only thing that make they different from Malaysia is they have currency derivative. And special one for Indonesia, they have a niche market which they specializes in commodity derivative. Last one is European Union. They have equity derivative, interest rate derivative, and commodity derivative. For last key features or risk management, Malaysia use a strict margin requirement and also daily market to market practices. For Singapore, they use a real-time monitoring system and a robust clearing system. For Indonesia, they still undergo several enhancement of framework. And the last one for European Union, they use tracking inherent risks and adapting to market change. That's all for comparative analysis derivative. We move to the next one, a real life example. For the last part, real life example of cooperation participation. This one is a real life example for voluntary carbon market. We have for Malaysia, corporation that participate is Simon B Plantation. For Singapore, we have DBS Bank. For Indonesia, we have PT Pertamina. And the last one is European Union, which is Shell and BP. That's all for my part. Thank you. Okay, now I will continue with comparative analysis for voluntary carbon market. We start first with Malaysia. Malaysia use platform of Bursa Carbon Exchange (BCX), while Singapore use Climate Impact X. Then for Indonesia, they use Indonesia Carbon Exchange, and the last one for European Union, they use Pro Earth. Key feature that Malaysia platform use are structured platform for voluntary carbon trading. The platform are used by the company to buy, sell carbon credit. And for Singapore, their platform are transparent and efficient carbon credit trading that are aligned with global carbon reduction strategies. move forward for Indonesia, which they have a unique key features, which they leverages forest resources for carbon credits. And the last one for European Union, they use a dual system, which is mandatory and voluntary market that high standard for transparency and integrity. For international standard, all of them adhere to a similar standard, which is verified carbon standard and gold standard. Except for European Union, they have a specific EU guideline that only the continent use. That's all for the comparative analysis. We move forward to the real life example. For the last part, real life example of cooperation participation. This one is a real life example for voluntary carbon market. We have for Malaysia, corporation that participate is Sam the Bee Plantation. For Singapore, we have DBS Bank. For Indonesia, we have PT Pertamina. And the last one is European Union, which is Shell and BP. That's all for my part. Thank you.
Conclusion: Robust regulation is key to Malaysia's financial market growth, especially in carbon and derivative sectors. Leveraging technology can boost efficiency and transparency, enhancing investor confidence and positioning Malaysia uniquely amongst its peers.